Thanks for watching, everyone. I'm Luke, and for this reinsurance news video interview, I'm pleased to welcome David Flandro, Managing Director, Head of Industry Analysis and Strategic Advisory at reinsurance broker Howden Re. David, it's great to see you. Thanks for taking the time to speak with me today.
It's a pleasure to be here, Luke. Thank you.
Thanks. So, Howden Re's January 2026 renewal report dissects what was a very interesting time for the reinsurance industry as it enters into a phase of rebalancing rather than outright softening, underpinned by a resilient yet fragile global economy. Of course, conditions vary by class, shaped by differing loss trends, supply-demand dynamics, and macroeconomic pressures. But the overall market enters 2026 from a position of strength. So, David, against this backdrop, it would be great to start with the opportunities and risks that you see emerging from the rebalancing of the market.
Well, thank you, Luke. Yeah, we thought a lot about the title of the report, and we thought rebalancing was appropriate because it is a rebalancing, particularly in the wake of the rapid rate increases that we saw starting on January 1st, 2023. And that said, when we first saw the draft of the report, I was a little surprised at how much of it focused on geopolitics and macroeconomics, and we debated that as well. But now it seems incredibly prescient. It seems like that was exactly the right topic for the report to discuss because such a big part of what's happening in the commercial insurance and reinsurance market comes down to global risk premium. And as we saw during the first weeks of this year, the world really is changing quite rapidly, whether it's in terms of the reordering of the global trading system, whether it's in terms of the hot and cold wars that seem to be emerging in the world, whether it's the interest rate picture that's emerging, particularly on the long end of the Japanese government bond market or the treasury market. So it's really appropriate because it's you don't want to look at the insurance and reinsurance sectors in a vacuum right now. You want that macro fundamental view because that may be actually what drives supply and demand going forward. So that's a big part of what the report highlights. And I think it's the biggest deep dive into, if you will, that part of the market that's available right now. So we hope it's useful to clients.
Yeah, great. So, as you noted, there's numerous macroeconomic and geopolitical trends that are highlighted in the report. But
Yeah.
are any of these that you think will most significantly influence risk pricing over the next couple of years, say?
Yeah, and it's really been with us now for a couple of years already. If you think about the recent past or the relatively recent past, going into the hard market, we were in an environment of depressed interest rates and, believe it or not, low inflation. That almost seems foreign to us now. What happened in 2022 and 2023 is that all reversed, and the environment that many people grew up in, that disinflationary environment, shifted significantly. We're now in a world with a risk-free rate, with inflation expectations, with elevated asset prices, and with higher yields. So that has implications for insurers and reinsurers in a number of ways. One of them is on the asset side of the balance sheet with running yields. But another one is very important, and it's on the pricing and underwriting side of the balance sheet. And we've come past the pricing peak in property catastrophe reinsurance rates online. We've come past the pricing peak in things like cyber, at least for the moment. We've come past the pricing peak in many specialty lines. The question now is, what is the hurdle return for carriers, and where's the floor? Do we go crashing through the floor like we did in 1996 or 2014? Do we have a series of events like we did in 2004 or 2005? Or do we maintain rates like we did in the late 2000s? And right now, it looks to us like there is a risk premium down there somewhere. There is a hurdle return that reinsurers have to meet, and that does portend some kind of floor if the market acts rationally in the near term. Now, we did say in the report that if current conditions persist, we expect pricing trends to consist. But the real thing that people are trying to think about right now is what happens 1 year, 3 years, and 5 years out so they can plan. And it looks to us decidedly like the world has become a lot more risky.
Yeah, yeah, good point. So, as well as these geopolitical trends, the Howden Re's January report it forecasts stronger growth in specific
Yeah.
segments beyond traditional lines. This includes cyber, renewables, and then data centers, which are becoming talked about more and more in the industry. So, which of these or others are expected to outpace the broader P&C market through, say, 2030, and why do you think?
Well, I think all of those areas that you mentioned still are expected to outpace the broader P&C market through 2030. At least that's what we're anticipating, particularly data centers. That's a very interesting area. I mean, this morning I was having a conversation about space. And so there are lots of areas, given our economy, that could outpace P&C growth. But furthermore, we know empirically from the report actually that P&C premium growth outpaces GDP growth,
Mm.
and or at least it has over the last 10 years. And so if we have a change in GDP growth pursuant to this changing global trading environment, that I think could portend good things for P&C insurance demand, even in a relatively softening pricing cycle.
Yeah.
And so far, the renewal at 1/1 was really the story of a shift in the supply curve. The demand side of the curve stayed the same.
Yeah.
It'll be really interesting when you're mentioning cyber, renewables, data centers, all these things, what happens to demand. And we'll be watching that very closely.
Yeah. Great. Okay. And then let's shift to the alternative capital market, which has
Yeah.
recorded really impressive growth over the past 3 years, the cat bond market and beyond. Do you expect this to persist? And does the expansion of ILS create additional pressures for traditional reinsurers?
Well, we've always been of the opinion that, if you will, alternative capital, as we used to call it, perhaps, or third-party capital, is a permanent and important part of the reinsurance market. And you can see in the report, I mean, and you guys have reported on this quite extensively, record net new issuance, record global outstanding, and that is an incredibly important part of the reinsurance dedicated capital base. When you measure dedicated capital the way we do, which is, I think, the most conservative in the market, alternative capital, if you will, now comprises between 20 and 25% of the total capital base. So it's an incredibly important part of capital supply, particularly for catastrophe, but also increasingly for specialty lines. And we expect that to continue. Whether we'll keep having net new issuance forever is another question. I suppose that the rate of new issuance surprised me a little bit in 2025. I've always thought of alternative capital as an S curve, where we had a really rapid expansion in the teens. And then in terms of percentage of capital, it was starting to top out, but it didn't. In 2025, it went up even more. And that's a sign of the alternative capital markets finding, new underwriting channels.
Yeah. Yeah, and as you mentioned, more recently it's moved in beyond the catastrophe space into areas, notably casualty. What do you
Yeah.
think is fueling that growth, and where do you see any risk to execution there?
Well, I think that the casualty ILS, and I've spent some time trying to understand casualty ILS. I'm not an expert by any means, but I think it's a completely different proposition from property cat ILS. I mean, cat ILS are a function of low correlation, high expected yield, high expected liquidity, and relatively short duration. Casualty ILS doesn't have all of those four factors. It has different factors. One of them, which I think is affecting investment into casualty ILS, is currently higher running yields, and then differences in inflation expectations and the ability to take on a part of the tail, if you will. And that is actually quite interesting for credit investors and other investors who are looking for uncorrelated assets that can be catered to their own portfolio. So I think this is a really interesting area, and I know people who are a lot smarter than me who are active in the space and quite sure that it's going to be a bigger part of the picture in future. Whether we get, a $70 billion inflow into casualty ILS like we did into property ILS during the teens is another question, but it's clearly an intriguing new asset class.
Yeah, no, good point. So now let's shift to the role of the broker in the current landscape, and specifically, in what ways can intermediaries such as Howden Re add the most value to clients in a cycle that's marked by intense competition and abundant capacity?
Well, we have to be much more multifaceted, I think, as a sector. Yes, of course, treaty placements and, working together with markets, with investors, and with buyers to find the best solutions as the market pricing environment changes. That's clearly crucial in treaty. And then utilizing facultative reinsurance in the right way at the right time, including DNF, including retro. All of those things are absolutely crucial. But brokers also need to bring strategic advisory to the table, whether that's advice around, I don't know, rating cap, reg cap, valuation, ALM, ERM, captives, all of those discussions that brokers are asked to have on a daily basis. We have to be adept at that. And there has to be a bridge into capital markets because, reinsurance is a form of contingent capital like equity and debt. And any intelligent buyer at scale will be considering reinsurance in that context. So it's treaty, fact, strategic advisory, capital markets, and finally MGAs. MGAs and facilities are an increasingly important part of the market for our clients, especially as the market pricing environment changes. So just at a minimum, brokers have to bring all five of those things to the table, in addition to all the other consultancies that we undertake. But that's an important part of the story, more so than it was 10 years ago, for sure.
Yeah, thanks. Okay, then to end, if you had to sum up your message to the industry, what would it be as the market moves deeper into this rebalancing phase?
Well, you know, going into the renewal, the report that we published was called Who Dares Wins, and it was a little punchy. This is called rebalancing, acknowledging that the market has rebalanced. But one of the analyses in the report is around economic value creation. And this gets us back to that hurdle rate that I was talking about earlier. Where is the floor? Is underwriting still profitable compared to 2 or 3 years ago? And I think what the market is realizing is that 2023, 2024, at least in the cat market, given loss experience and given where attachment points were, those were highly profitable years for reinsurers. The question now is, with this, if you will, re-rating, how profitable is the market? And I've heard people talk about ROEs and combined ratios, and those are, of course, important metrics. But even more important is a firm's return on invested capital minus its weighted average cost of capital. And that is economic value creation. And it's our assessment that in most lines, economic value creation is still happening. So a marginal dollar of new premium equals economic value creation. And we have to remember, we've come off a very high. We are nowhere near the floor that we reached in 2017 and 2018. We don't want to get back there. We want the market to stay rational. But in this environment, there is plenty of opportunity for underwriters to achieve profitable growth. And that's what we're here to help with.
Yeah. David, look, great. Thanks. Thanks for your insights today. It was great speaking to you, and good luck with the rest of the year.
Likewise, have a great year, Luke.
Thanks. Cheers, David.